Good morning, everyone. Tim Nyland here. This is our weekly internal Zacks Professional Services Strategy Call. Today is September 23rd of 2020. I am going to do a little bit different session this week. We're going to take a look at technology valuations specifically, and we're going to kind of take on the talk in the markets over the last several weeks that somehow the technology sector still needs to correct more, and that the only way the remainder of the market can participate is for technology to give up additional valuation. So we're going to take a look at this theory. We're going to throw some cold water all over it and kind of take a look at some different approaches that I would suggest that anyone who's managing money, financial advisors, portfolio managers, take a look at, and not necessarily listening to all the pundits out there that just think things are overvalued without actually providing details behind the argument. So in order to get started, I want to just take a look at Apple, Microsoft, and Adobe very quickly. And what I'm going to do is I'm going to use the Zacks Research System, specifically the valuation model. And I've got Apple up on the screen here. We're looking at about a 15-year history. And I'm going to just go ahead and make sure that my model is set to default. And what we're doing is we're actually looking at a sell-side bid to valuation, or what valuations would look like if we had a fully vetted sell-side forecast incorporated. And so you can see that the forecast growth rate for Apple is about 10.67%. And in default, we take off one standard deviation of that. So we're going to come down to about 8%. And notice that if Apple were only going to grow at about 8%, we'd be looking at a current model return of negative 17%. So right away, we know that the buy side has bid the valuation of Apple up to grow in excess of this tapered down growth rate that's coming in from the sell side. If I look at my consensus forecast for 2020, 2021, and 2022, I can see 9%, 24%, and 8% growth. And the interesting thing is that this is what's really incorporated into that super cycle for iPhones, that 24%. But based on what I have learned, and specifically in talking with Verizon and some of the other carriers, is that this 5G supercycle is actually going to go on for years. And so I would be really, really leery of this growth rate at 8% out here for FY3. I think it might actually be a little bit higher, because if you talk to these cell phone carriers, the 5G network is still going to be being built out even 3 and 4 years from now, before it hits some of the more rural areas of the United States. So this isn't just going to be a regular cycle for Apple. And if you couple that with everything they've got going on in services and wearables, I think we're looking at something a little bit different here. So the idea here with Apple is we need to determine what the actual market implied growth rate is. And in order to do that, I can simply just go ahead and use my arrow tool over here and use this right button to ratchet the slope of this model earnings growth rate up. So it would literally bring that growth forecast up. Before we do that, what you're seeing is that an 8% growth rate, Apple would only be trading at a 22 multiple. We're currently sitting at about a 27 multiple on F12M earnings. And so notice that each click I click this arrow tool, I bring my growth assumption up by 10 basis points, and my model PE begins to approach the actual PE, model price begins to approach actual price, and current model return begins to approach 0 up until the point at which current model return is 0. Then the model is in equilibrium, and I can force it by simply clicking on this market implied growth rate. And you can see that everything is in equilibrium now, and I got a current model return of 0. So the buy side has basically bid the long-term growth rate up to 10.21%. Now, you can see what the latest correction looks like for Apple. And you'll also, if you've been listening to CNBC and obviously reading any financial publication you pick up, they talk about how much farther does Apple have to fall. And it can certainly go down. I mean, we overshot on the upside. It's very traditional that, valuations overshoot on the downside during a correction. But in terms of valuation, and specifically the buy side bid to valuation, it looks fairly close to sell side forecast here if you normalize this trend out. So 9% to 24 to 8, I'm suspect of that FY3 number for reasons I just explained to you. So we're going to forensically dig into this thing a little bit. I have 3 favorite screens that I love to use to just challenge things that I hear quickly in the media. If I want to do a quick and dirty valuation, this is what I do. And the first thing I'm going to call to everyone's attention is just this massive share buyback. Again, returning capital to shareholders. This is obviously of tremendous value. And you can see how this actually impacts the diluted versus aggregate growth rates in both earnings and revenues. So what we're looking at is basically year-over-year percentage change quarterly. And we're looking at the prior 2 years and then the forecast 4 quarters forward. And what I want everyone to notice is that on a diluted basis, you've got 12 and 13% growth. And in aggregate, you've got roughly 5 to 6% growth, with that growth actually accelerating to 8, 9% as we're ramping up into this super cycle. So just very naively speaking, is this 10.21 analyst growth rate that we backed into, that's the buy side implied bid to valuation, is that out of range? Actually not, right? It's pretty much in line with aggregate revenue growth. And if you take into account the share buyback, you're actually sitting at about 14% revenue growth for the next 12 months as we ramp up through this super cycle. So what I want to bring to everyone's attention is something that Apple has done very well on the margin side, and that they've been able to maintain not only gross margins, but operating margins and even their net margins in the face of these super cycles that they go through in these revenues. Now, the variability in revenues. And where I'm going with this is that once this service business and the wearables business becomes a larger component of Apple's revenue stream, you're going to start to see this stuff smooth out. And the nice thing is they've just been rock solid on these margins. And so anything that they can do to just get us a little bit of a bump in perhaps reducing the input costs, right? Or maybe a little bit of an increase in their operational efficiency. Again, the EBIT margin is your operating margin. This is definitely the most important margin. It has been on the decline literally since 2012. So perhaps there is some opportunity here to start bringing this back up. And I know that's probably, what Tim Cook is looking at from a financial perspective. So any improvements you can make here and here, in addition to this revenue ramping up, has basically a multiplicative effect on your net margins, which is obviously what's driving those valuations. So I don't see anything but good things for Apple fundamentally. And as far as how much further does Apple really have to fall, I would say that we're sitting pretty close to fair value right now. And the market's going to do its thing. The buy side's going to find its valuation. I think we're getting close. So let's take a look at another one of our tilt stocks, which is Microsoft. And this is one that people, have a hard time with. And again, I try to relate it to the fact that they've gone, especially with their Office suite and a lot of their enterprise software, to a subscription model, which is just game changing, right? With Azure Server, with Office, with Teams, you name it. And the chart looks strikingly similar to a transformation that Adobe had right back here in 2011, 2012. And you can see what happened to Adobe's earnings along with the valuation of Adobe when they moved over to their subscription model. So the Adobe software platform absolutely just took off in terms of revenue generation. You can see the earnings just starting to crank out. Microsoft did exactly the same thing. And along with it, margin expansion and everything else that you would expect to take place. So the idea is, how do we value something like this? So I'm going to go ahead and set the model back to default. Notice I've got about a 2.25% standard deviation. So I'm going to take one standard deviation off. It does it automatically in default from that 3 to 5 year consensus growth forecast for earnings coming in from the sell side. So we're not going to model the 13.71. We're going to knock the one standard deviation off as a measure of conservatism. We're going to model 11.5%. And you can see that in default, we're pretty much spot on. We only have a 0.5% current model return. So basically, the buy side is valuing Microsoft at the sell side growth rate estimate long-term minus 1 standard deviation. So we're actually sitting at fair value right now. So the idea is we need to take this 11.5% market implied growth rate and we need to map it against sell side forecast 11, 12, right, 10% for 2023 and see if this 11.5% growth rate is reasonable. From an earnings perspective, it looks like it is, but we need to see if this growth is actually both sustainable and supportable long term. So it appears as though Microsoft is sitting at really fair value right now, and you can see how this thing has just literally been stair-stepping like this. I want to say all the way back to the end of 2016. I mean, we have these ramp-ups every single year, and we get a little bit of a pullback at the start of the year. Boom, we ramp up again, another pullback. So, like the idea is, where do we go from here? And obviously, Microsoft being a bellwether financial, these are important questions for us to know the answers to before we start taking a look at the larger IT space. What we're doing is we're just kind of orientating ourselves with some of these valuation trends right now. And what I want everyone to see is that we definitely have a slowdown in growth, and this is probably more related to Azure Server tapering off a little bit. I'd have to dig into the numbers a little bit more on that. But what I am seeing here is obviously 20% growth tapering back down to that, you can call it 9-10%. They've got a slight share buyback going on here, not impacting the growth too much. But again, if we take this these percentage change and we look at the fact that we had a significant ramp up here, the idea is what normalized growth might be is something actually a little bit higher than 10%, since we're coming off a 37% growth in December 19. Obviously, this growth rate here of 5% would actually be a little bit more because this was so high. So certainly 11.5% is not out of the question. And when we talk about the sustainability and supportability, if we look at revenue growth long term, over the last 5 years, they have grown aggregate revenues at 11%. So, is this out of the question, this valuation? The answer is absolutely not. The other thing you can see as well from a margin perspective with Microsoft is something that we see with other companies, and that net margin continues to rise, right? This bump right here, you've got to kind of just see through this. Our net income is adjusted. So anything what we call below the line is adjusted for one-time non-recurring items, and it looks as though we had some sort of one-time gain in our operating, that's hit our operating margins here. So this line should really be straight. What we're really concerned with is this trend here. And this is really good. And if we can just keep this revenue line stable and continue to improve this operating margin, this net margin should be just fine. So without doing a much deeper dive, I don't see anything, earth-shattering here for Microsoft. It's sitting pretty much at fair value. And the last one I'm going to bump through really quick before we actually dive into the tech sector, and I'm hoping that everybody's starting to see a trend here, is Adobe. It's another one of our, bellwether tilt names. And this one actually carries a little bit higher valuation. The interesting thing to note here is that one standard deviation taken away from the 3 to 5 year consensus growth rate estimate mean goes from 16% down to 10%, right? So what that tells us is that we've got analysts, all over the map in terms of, how fast Adobe's actually going to grow over the next 3 to 5 years. And the interesting thing is that the buy side is more inclined to be closer to consensus versus -1 standard deviation, because if I look at the current model return, I can see if Adobe's only going to grow at 10.71%, the stock would literally fall by 44%. And so the idea is I'm going to click on the market implied growth rate and back into the buy side implied valuation. You can see that it's really close to consensus, right? It's 16.89. And again, we're going to ask ourselves, is that out of reason? I mean, has Adobe run up too far too fast? And if you look at the fact that in 2020, we're at 26% growth, a lot of this is COVID driven. 2021, 15%. Now that there's a fear of resurgence and we don't have everything opening up as fast, obviously the reopening trade is unraveled. Disney, Starbucks, they've fallen. I think Starbucks fell from 89 down to 84. Disney was at like 133. It's back down to like 122 now. So these rotation trades that we keep expecting keep not panning out. And so companies like Adobe, the CEO again saying, you're not going to put this genie back in the bottle. Is this 15% growth accurate? Is it going to be something a little bit higher now that we're seeing with COVID resurgence? We don't know, but certainly a 16.89 implied growth off of 17% in FY3 might be reasonable. We look at the sustainability and supportability of this 16.89% growth. And again, a share buyback going on here, about 1% effect on aggregate versus diluted growth. But you can see clearly that 16.89 is not out of the realm. Over the last 5 years, this guy's grown at 23% top line and 41% bottom line. Just enormous numbers here. And again, if you normalize this out, coming off of 41% growth, obviously tapering down to 13 and 9 here, that would actually be a little bit higher. 16.89 is definitely not out of the realm, especially when we're looking at 14, 15% top line growth. So again, roughly fair valuations for some of our larger tilts. I don't want to go ahead and dive through any more of them. The trend is the same. Actually, Facebook is super cheap. There's obviously some regulatory concerns there with Facebook and other things, but Facebook's probably the cheapest of all of them. But what I want to do at this point is talk about the 1,000-pound gorilla in the room, and let's approach technology from more of a top-down perspective. And what I want to do is I want to take a look at what the media keeps reporting on. And we're going to start with probably my favorite measure right now, which is a PEF2. And what I'm going to do is I'm actually going to grab the information technology sector, and we're going to look at this relative to the market-weighted S&P 500. So this is the actual S&P 500 index, if you will. But we're looking at PEFY2. So again, we're looking through the trough over the next 1 year, and we're actually looking more or less 2 years out. And what we see is what the media is reporting, that this thing is expensive. We're literally sitting at all-time record high valuations. And the thing that frustrates me even more so than anything is that everybody continues to report that the information technology sector has to continue to give up gains for everyone else to be able to participate in the market. So the idea is the media wants you to believe that in order for the market to rise, all sectors need to rise outside of tech, and tech needs to come down. And that's just not true. And I'm going to show you why. So the first thing I'm going to show you is that when you start looking at different valuation metrics, you start reining in some of these valuation assumptions that are being thrown around. So we're going to take a look at a 1.26 relative. So we're trading at a 26% premium over the S&P 500, and the median is only a 4% premium. The high is a 29% premium that we just sold off from. And this is again over the last 15 years. The reason I chose 15 years is I wanted to eliminate the dot-com bust and 9/11. So I only wanted to get in here the financial crisis and the subsequent recovery. I did this on purpose. And so what I want to do now is I want to take you through some of my favorite ways to look at and challenge this notion that tech needs to continue to sell off. And so what we're going to do now is we're going to back into a PEF12. And you can see that valuations get a little bit cheaper. 123, median of 102, high of 130, but not much, right? So fairly consistent with the PEF2, and that's probably because the Infotech, from a composite perspective, is an F12, and we're only a couple months difference in interpolated points between FY1 and FY2, between F12M and FY2, so they're fairly close. But the reason I wanted to show you the PEF12M is you're going to get a really, really different picture now in terms of valuation when you look at the one thing that I've been really trying to hammer home over months and months, ever since we rolled out the tilt recommendations in March of this year, which is tech is where the growth is, okay? So if we then take this PEF12M ratio and we divide this by the growth rate estimate mean, okay? We just talked about the growth rate estimate mean and how important it was to determine valuations using our valuation model. Now we're actually going to use it in this valuation ratio. And this is where things start to get interesting. So here's your PEF12M divided by the EPS growth rate estimate mean, otherwise known as a PEG ratio. Now we are arriving at a valuation that is well within its 15-year median. As a matter of fact, relative to the S&P 500, if you account for growth, and again, the growth component of this ratio is what I've been focused on, and that's really what I've been focused on because this is really where the growth is. If you divide that growth estimate not only by the tech market but by the S&P 500, you see that technology relative to growth, its valuation is exactly that of the market. We're only literally 0.03 off, current of 0.91, median of 0.88, and we're nowhere near the high point of a 6% premium. Okay, now let's take a measure of conservatism here and let's knock off one standard deviation of the growth rate and let's see what happens then. Okay, so now we've got the technology sector actually trading at a discount to its 15-year median F12M PEG ratio minus one standard deviation, right? More closer to the low range. So we've got this massive growth component in technology that the media, CNBC pundits just have a really hard time fessing up to the fact that, you know what, this is where the growth is and these valuations maybe are reasonable. And so what we can do to further challenge this notion, again, what I like to do in my training is I like to give everyone a lot of things to think about, right? So we're looking at some very basic PE ratios. But PE ratios are very misleading, especially when you're talking about technology and considering for a moment that Apple carries about a 6.5% weight in the tech sector. And when you look at the balance sheets of these names, and I'm going to go into our summary standardized balance sheets, and you look at the market weighted average cash position, okay, of the market weighted average stock in the S&P 500 tech sector, they are sitting on 31% in cash. Yes, they've got some debt, right? But the problem with the PE ratio is that it doesn't consider the amount of debt or cash that a company has on its balance sheet. Now, keep in mind that if you roll the tape back several training sessions, webinars ago, we talked about some of the issues with ExxonMobil and some of these other companies that are just issuing massive amounts of debt to keep up with their dividend requirements. And the PE ratio itself is really not going to capture that as well as, say, an enterprise value to EBIT or even EBITDA or something to that effect. So in order for us to basically give credit to the technology sector for literally having the highest percentage of cash to assets of any sector in the S&P 500, what we really need to do to further challenge this notion of how technology is valued is use valuation ratios that more or less give credit to the technology sector for having this superior cash position. And we can do this, right? So if we look at what we have in terms of enterprise value, and we have a whole section of enterprise value ratios, we're just going to look at some of the more basic ones here: enterprise value to EBITDA and enterprise value to EBIT. So the nice thing is that when you're looking at enterprise value, again, you're looking at a measure of a firm's total value. So it includes the market cap of the company, and then you add in both the short-term and long-term debt, and then you obviously give credit for any cash that's sitting on the balance sheet. So when we look at enterprise value to EBITDA for the S&P 500, you'll see that we are nowhere near high valuations. As a matter of fact, we're just literally, we had gone down from the recovery of the Great Recession, and now we're literally on our way back up. Yes, we're a little bit of a premium in terms of where we stand relative to our 15-year median, but we're at 1.58. The low is 0.88 and the high is 2.52. Okay. So these valuations appear to be very, very reasonable, especially when you consider the amount of growth that we're looking at and the fact that the Federal Reserve has literally said they're backstopping the economy for as long as it takes. The latest inflation projections I've seen is that we're not even going to have inflation back to the 2% Fed target until 2023. So that is very, very bullish for the technology sector, and you're seeing that here in terms of valuations, enterprise value to EBITDA. So EBITDA is really good for valuing capital-intensive businesses with high levels of depreciation and amortization. And I'm going to give everyone a little tip on how to envision the difference between EBIT and EBITDA and really, what it means. If you go into the financials and you go into summary standardized income statement, the way that I designed the income statement in here is so that it could be used across sectors, across industries, but it also outlines these really critical inflection points. You can see EBIT right here, EBITDA, gross profit, and revenues. And you basically read from the bottom, right? So you've got your GAAP earnings. We take out any adjustments. You end up with your non-recurring items. And then you basically roll up. This is your net income before non-recurring items. And you basically start rolling up. So this is your operating profit here, EBIT, right? And so if you were to take EBIT divided by revenues, that's where you get your operating margin. So this is real operating income here. And then EBITDA literally adds back your depreciation and amortization. So you add back SG&A and R&D, you get to gross profit, add back cost of goods sold, you get back to revenues. So the idea is when we're looking at this from a valuation perspective, EBITDA is going to be, again, useful for looking at those capital-intensive businesses because you're basically adding back that depreciation and amortization, right? So you're putting everything on an equal footing, assuming that's removed. It's a non-cash expense. And then EBIT is going to be useful for valuing businesses with core operations, like without the drawback of removing that depreciation and amortization. So let's take a look at enterprise value to EBIT, which is another one of my favorites for the IT sector. And you can see that this scenario looks even better. And so this is kind of a true operations, from operations relative to total firm value look at the technology sector. And so the idea is here, we had been on the decline since literally 2005. We bottomed at the end of 2015, and we're now just coming back up. So, the idea is we can look at this many, many different ways. And I wish that, the media and some of the pundits would look at this from a more complete perspective instead of just always looking at PE ratios, because PE ratios don't give you the entire picture. You really need to kind of slice and dice your way through the income statement, like I was showing you, to look at how these various levels of valuations can be interpreted. And there are a lot of differences. And the idea is that I prefer to use all of these in conjunction with your traditional price to sales, price to book, price to cash flow, including the results coming out of the valuation model. If the valuation model was telling me that, Apple was, way undervalued, and I'm looking at, an EV to EBIT that's sitting up here at levels we haven't seen since 2006, I might challenge the results coming out of the valuation model. But these valuations appear to be extremely reasonable. And again, the problem with using just straight PE ratios to value the tech sector is it makes the tech sector just look extremely expensive. So the media is right with that one particular valuation metric. It does look expensive. But it doesn't account for the amount of debt. Again, debt with these low record levels of interest, they actually create firm value, right? If you look at weighted average cost of capital. And it doesn't consider the amount of cash that's sitting on these technology companies' balance sheets. And that is the real story that you want to pay attention to. So that's all I've got for today. And we'll go ahead and pick this up again next week. Thank you, everyone.